In the spring of 2020, global travel stopped. Within 8 weeks, Airbnb's gross booking value dropped 80%, and $13 billion of its private valuation vanished. To stay online, leadership accepted an emergency $1 billion loan from private equity firms. The terms were predatory, a 10% interest rate, and warrants to purchase stock at a massive discount compared to their previous valuation. This financial panic happened to a company that owns 0 hotels, 0 real estate, and 0 mattresses. At the time, the platform was burning $250 million a month, despite the fact that nobody was using it. The near collapse revealed the platform's true architecture, a machine designed to run on a constant, massive influx of liquid cash. The business relies on a structural delay. Guests are charged at booking, but the platform holds the money until check-in. Scaled across 500 million bookings, this creates a $9.2 billion pool called the float. Airbnb parks these deposits in treasury bills, earning interest. In 2023, this shadow treasury operation generated $721 million in interest income. That single mechanic accounted for 28% of the company's entire reported operating profit. When travel stopped in 2020, the float drained. This was a bank run in all but name, proving that the company's survival depends entirely on its ability to hold user deposits. The platform captures a 16% fee on transactions, while using its terms of service to shift all physical risk, including fire, injury, and assault, entirely onto the individual property owners. This hands-off approach has real-world consequences. Deadly fires have occurred in uninspected, unverified properties, where the company relies solely on hosts to self-certify their own safety compliance. To manage worst-case safety failures, the company maintains a secretive internal crisis unit known as the Black Box Team, staffed by specialists recruited from military intelligence and emergency medicine. In 2015, after a guest was assaulted at knife point in a Manhattan rental, the Black Box Team negotiated a $7 million settlement. In exchange for the payment, the victim signed a mandatory non-disclosure agreement, permanently burying the incident from the public record. Paying multi-million-dollar secret settlements is a deliberate feature of the system. It is significantly cheaper than assuming the legal liability of inspecting millions of properties. In Italy, the company refused to collect a legally required 21% income tax for 6 years. This maintained a price advantage for the platform, while shifting the risk of tax evasion onto individual hosts. Faster, more urgently. The standoff ended in late 2023 when Italian prosecutors executed a criminal freeze of €779 million. Faced with its liquidity being locked by law enforcement, the company settled the unpaid withholding liabilities. Internal attempts to impose financial discipline were also suppressed. Lawrence Tossi, a former Blackstone veteran brought in to professionalize the company, was pushed out after clashing with the CEO over unit economics and acquisitions. Upon going public, the founders implemented a dual-class stock structure, giving themselves 80.6% of the voting power. This ensures that no external investor can challenge their strategy. Dodging the taxes, silencing the victims, and ousting disciplined executives are all mechanisms used to insulate the float from internal or external threats. The global regulatory crackdown is currently threatening the platform's core financial engine. Every listing removed by local laws directly reduces the guest deposits the company can hold. New York City wiped out 92% of active listings, and Barcelona committed to revoking every one of its 10,000 tourist apartment licenses by 2028. This chart shows the projected impact of falling interest rates. As the Federal Reserve lowers rates, the yield generated by the $9.2 billion deposit pool compresses, creating a massive headwind for the company's operating income. The period of high interest rates and unchecked global expansion is over. The coming squeeze will expose the thin operational margins hidden beneath the platform. Airbnb operates as a float-funded financial intermediary, using a global travel interface as its primary customer acquisition channel. Next, we look at another global brand hiding its true scale behind a simple product. On the surface, it's a hamburger chain. In the ledger, it's one of the largest real estate investment trusts on Earth, holding $40 billion in property and collecting rent from its own franchisees. If the real estate operation is worth more than the food, why do they still need to sell the burgers?